So let's talk about annuities. Life insurance companies are where you get annuities. It's an insurance company product. And any guarantees you get from them are based on the claims paying ability of the insurance company. So if the insurance company goes out of business, that guarantee is gone. But let's put some perspective on this. According to the National Organization of Life and Health Insurance Guarantee Association, since 1991, that's 34 years, 9 life insurance companies have declared bankruptcy. Two of those I'll note were in New York. According to FDIC, 576 banks have failed since 2000. Now, throughout this, we're going to say this, but annuity companies slash life insurance companies don't have FDIC in coverage like the banks do. So, some things that all annuities have in common. As I mentioned, no FDIC insurance. They're all a life insurance company product. All guarantees are based on the claims paying ability of the insurance company. Now, they usually have surrender penalties greater and longer than bank CDs. Surrender penalties may or may not eat into the principal. And when you pull the money out, any gains, any profits are taxed as ordinary income. It does not have the potentially favorable capital gains and dividends tax treatment of other investments. And if you pull your money out in the wrong way before you turn 59 and a half, there might be additional IRS penalties. So keep that in mind. These things are long-term holdings. They're not to be used for short-term needs. So don't be saving them for that vacation in the next 2 years because it's probably a bad idea. Okay, so some of the advantages of annuities. They may have guarantees that bank CDs don't. They may have a higher long-term potential for growth. And the gains, realized capital gains, dividends, etc., are not taxed as long as the funds remain inside the annuity. And it automatically makes you put beneficiaries on so that if you die, the funds passed where you want it to. Some of the disadvantages. They're not a short-term investment. That means it is not a liquid investment, meaning it's hard to access, especially early on in the contract. There are usually substantial surrender penalties in the early years. And as I mentioned, there's potential IRS penalties if you withdraw the money before 59 and a half. All the gains, all the profits are taxed as ordinary income. And if you put a annuity in a qualified plan like a Roth, IRA, or other employer-sponsored retirement plans, they do not enjoy any additional tax advantages that annuities provide. And unlike other investments, there is no step up in basis at death. Okay, let's go through the different types of annuities. The single premium immediate annuity, which I'll henceforth refer to as a SPIA, it's the simplest annuity to explain. You basically hand a bag of money to the insurance company and they promise to send you a guaranteed annual income for as long as you're alive. So as long as you've got a pulse and you're alive, money keeps coming in. The older you are, when you start the contract, the greater the annual income. Basically, the closer you are to meeting your maker, the more money they're willing to give you per year. And there's some options on these type of annuities. The one that gets you the biggest annual check is the life only. So if you live 2 years, the checks stop at death. If you live 20 years, the checks stop at death. Now, sometimes people can't stomach the fact that, hey, if I get hit by a bus in 6 months, all that money just gets kept by the insurance company. So they'll get something called a life with a period certain. And if there's a life with period certain, they usually come with 5, 10, or 20-year periods, which means the annuity pays as long as you're alive, or for 5, 10, or 20 years if you don't live that long. Life with refund of premium. These will pay as long as you're alive, generally speaking. But if you die before the amount you put in is paid out, then the remainder will be paid to your heirs. And then there's such a thing as joint life. That's where you have two annuitants, and it will pay as long as one of you's alive. Like I said, the life only is the one with the biggest annual check, and the rest are less. Read your contract carefully. Okay, fixed annuities. These look a lot like bank CDs. As I mentioned before, there's no FDIC insurance. And unlike bank CDs, which will usually charge you a few months worth of interest, if you pull them out, substantial penalties are on these fixed annuities if you pull them out early. And it may or may not eat into your principal. But they have low and no internal expenses, and they have virtually no market risk. Okay, indexed annuities. There's no FDIC insurance. You're going to see that as a pattern here. And we talked about surrender penalties may or may not eat into the principal. They have low or no internal expenses. They're subject to some market risks. These annuities are linked, as specified in the contract, to specific indexes. Usually it's the S&P 500 or the NASDAQ. There's no actual securities in the contract. There's usually a floor, which limits the amount the annuity contract can go down in a specific period, and a ceiling, the amount it can go up. Read your contract carefully. Now, then there's a new thing called registered index linked annuities, which I'm going to call RILAs from now on. No FDIC insurance, low or no internal expenses, and like the indexed annuities, they're linked to specific index. However, the return at the end of the specified period will be based on the index it's linked to. Again, no actual securities. There is market risk, but some of the risk is limited by a buffer stated in the contract from the insurance company. You can suffer losses in this type of annuity. The potential for loss is limited by the buffer stated in the contract. There's also a ceiling. So if the associated index exceeds the ceiling, the contract will only get the ceiling rate of return. So if the buffer, say, for instance, is 10%, if the index is down 5%, the contract will suffer no loss. However, if, say, the index is down 20%, the insurance company will suck up that first 10% of the loss, and the contract will absorb the other 10%, coming in at 90% of its value at the beginning of the period. Now, suppose that same contract had a ceiling of 12%. If the index is up 7% for the period, contract will gain 7%. If the index is up 20%, the contract will gain 12%. Variable annuities. Fees are the highest for any type of annuity. Market risk is dependent on the investments in the sub-accounts. It is possible to suffer losses in a variable annuity. They also have the largest potential for gain or losses of any type of annuity. Note there are actual securities in the contract. There are riders which may mitigate some of the risks, like there's a return of premium rider that you can get. Basically, it means if you stay in the annuity under the terms of the contract for a specific length of time, you get all your money back. Living benefit, which means you can get a certain amount of income, can be guaranteed, again, subject to terms and conditions. This one is critical to examine your contract and review it on a regular basis, as it has a lot of moving parts. Check with your agent prior to taking action on your variable annuity. Okay, quick comparison. Okay, SPIA, it's for those desiring a fixed annual income for life. Fixed annuity for those who were risk averse but not needing the money in the short term. Index annuity for those who have some risk aversion but do not need the money in short order. RILAs, little risk aversion, not willing to pay expenses but do not need the money in the short term. Variable annuities, for those who want to participate in the market, possibly access living benefits or some guarantees that do not need the money in the short term. So you're seeing a pattern there. With the exception of the SPIA, these annuities should not be used for anyone needing to use the money in the short term. An annuity as part of a financial plan may or may not be suitable investment for an individual. Annuities are not the right fit for every person or situation. They're long-term investments. They may have fees and expenses that will affect the rate of return. All annuities require a person with an insurance license, and with the exception of SPIAs and fixed annuities, a securities license is usually required. Once you graduate, be it from welding school, engineering school, or law school, you're going to need a different plan for each of these stages that's tailored to your individual situation. During your working years, am I saving enough and is it in the right place? When you're on the glide path to retirement, which I define as the last 10 years prior to retirement, will the USS retirement be shipshape on the appointed day? And retirement, how do I avoid running out of money before I run out of life? Legacy, this is what I worked hard for, get to where I want it to after I'm done with retirement. I can be reached at herwirefinancial.com. I do in-person, Zoom, and phone appointments. I am licensed and registered across several states and can easily add states if there's a need. If you want to schedule an appointment, click on that schedule an appointment in the upper right-hand corner. If you want to catch more videos like this, go to my YouTube channel, which is the red button, a couple of buttons over. My phone number, 518-631-2569. Do not text that number. You'll be sad, I'll be sad, because I won't get it. I have a separate texting number there. This material contains only general descriptions, is not a solicitation to sell any insurance product or security, nor is it intended as any tax or financial advice. For information about specific insurance needs or situation, contact your insurance agent. This is intended to assist in educating you about insurance generally and not to provide personal service. It may not take into account your personal characteristics such as budget, assets, risk tolerance, family situation, or activities, which may affect the type of insurance that would be right for you. In addition, state insurance laws and insurance underwriting rules may affect available coverage and its cost. If you need more information or would like personal advice, you should consult an insurance professional. You may also visit your state's insurance department for more information, riders, or additional guarantee options. They're available to an annuity or life insurance contract holder. While some riders are part of the existing contract, many may carry additional fees, charges, and restrictions, and the policyholder should review their contract prior to purchasing. Opinions voiced in this material for general, all performance references historical, no guarantee of future results. All indices are unmanaged, may not be invested indirectly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor. Unmanaged index returns do not reflect fees, expenses, or sales charges. No show next week. Everybody have a happy 4th of July. Godspeed.